very good evening to all of us here in India and in the Far East. Good morning to friends in North America and good afternoon to everyone in Europe. My name is Ramraj. I head the India Impact Investors Council, and as several of you are aware, IIC has been working quite substantially in the space of attracting greater amounts of impact capital to India. And this event, Prabhav 2020, India Impact Investing Week, is an effort in this direction. Today's session is on a very interesting topic, namely debt financing in the impact sector. We have a very illustrious panel here, and I'm hoping for a vigorous and animated discussion. This session is brought to you by our session partner, Vivriti Capital, and Bridgespan Consulting, who is our knowledge partner. Please note, we also have a parallel session in Audi 2 on entrepreneur perspectives on marrying impact and profits. Chair of IIC, Siddharth Nautiyal, is interviewing 3 leading impact entrepreneurs to get their views on how they maintain this balance between impact and the profits and purpose. This session is divided into 2 parts. We'll start with a brief presentation on IIC-Bridgespan's latest research report on debt financing in the impact space. That presentation will run for about 10 to 11 minutes. After that, I'm going to hand over to Vineet from Vivriti, who's the official moderator for the session and who will take proceedings forward. While this session was originally slated for 75 minutes, we will most probably extend it by another 15 minutes. Before we begin, a quick introduction to this very, very impressive galaxy of panelists. Starting off, Royston Braganza is one of the veterans of the development debt financing ecosystems in the country, right from the microfinance days to his present position as CEO of Grameen Capital, an impact-focused NBFC. Royston also sits on the board of IIC. Royston, don't spoil my flow now. Vineet is founder of Vivriti Capital, a unique tech and analytics-focused NBFC, which is working on transforming the SME financing model in India using technology very, very centrally in their business model. Eric Naranjo, Director of Innovative Finance and Strategic Initiatives at USAID. USAID has been at the forefront of using guarantees and structured finance transactions in supporting the impact sector. USAID is also a charter member of the IIC, and we are deeply thankful, Eric, for your support. Ajay Rao, Managing Director, South Asia Region DFC, which is the development finance arm of the US government and was earlier known as OPIC. DFC has had a strong presence in the Indian impact sector. And in recent times, what's really caught our eyes is a material increase in the debt-related investments over the past few months, the latest one being Samonniti Financial, which I'm not wrong, just happened just about last week. Yasmin Lami is Deputy CIO Catalyst Strategy, CDC Group PLC. CDC is one of the largest impact investors globally and in India. That's well known, but Catalyst Strategy's team, which Yasmin heads, is building a portfolio aimed at transformational system-level impact and innovation across its target geographies of Africa and South Asia. Ishpreet Singh Gandhi is founder, Strides Ventures, a debt fund operating in India, which has built up material exposure to several impact-funded ventures in the country. Ishpreet has a long career and varied exposure in the Indian banking sector across credit at Citi, IDFC Bank, and others. Lastly, but most importantly, Sam Whitmore, who's manager with Bridgespan, who's been our co-conspirator, if you may say that, in putting together the report that we are going to launch shortly. Sam is based in Boston and I must say has done countless 7:30 a.m. meetings with us in bringing this report together. Sam has had a diverse experience in the consulting space and has been with Bridgespan for the last 5 years. So without further ado, we will dive into the presentation. Sam will run you through the meat of the presentation and I will give you the conclusions before we hand it over to Vineet to take it forward. Over to you, Sam.
Wonderful. Thank you, Ramaj, for that very kind introduction. I'll just pull up my screen to share here. And we should be good to go. Great. Well, as Ramraj mentioned, the Bridgespan Group is a social sector consultancy that supports impact investors, philanthropists, and NGOs. And over the last several months, we've been working with our colleagues at the IIC on a research study looking at the use of debt among India's impact enterprises. And so we looked at a set of over 400 leading impact enterprises, and one of our core findings is that the use of debt is generally lagging behind equity. And so despite the fact that many of these enterprises appear creditworthy and able to absorb more debt, we don't see as much uptake on the market as we might hope. So our hope is that this report will help inform the development and scaling of a broader range of debt financing instruments to support the growth of India's impact sector. So I'll just spend a few minutes sharing some high-level observations from that work, and then turn it back to Ramraj to discuss some of the implications as set up for our panel discussion. So over the last decade, the impact investing sector in India has seen a broad diversification beyond the microfinance sector. So we might think of 2000 to roughly 2010 as sort of a first generation of impact investing, where microfinance was the most widely known business model for how private enterprises could create social good. And since 2010, we have this diversification into newer sectors, so both broader financial services, as well as agriculture, education, healthcare, technology, and others. During that period, impact investments have continued to grow. Since 2015, total investment among the companies that we studied has increased about 2.5x. And while there's been important growth in the use of debt, equity continues to outpace that by about 3 to 1 or so. Now, if we look at a sectoral breakdown of equity and debt, we see two things. So the first is that equity is more widely diversified beyond just financial inclusion. And so this sort of broadening out of the impact investment sector that we see is largely driven by a broadening of the use of equity into sectors beyond financial inclusion. On the debt side, things remain relatively concentrated within the financial inclusion sector, largely driven by microfinance institutions for whom debt is essentially the raw materials of the business model. And so we observe this broad diversification and also see that debt has not yet followed the same trend that we've seen among equity. And so it raises the question, naturally, why might that be? And certainly a logical explanation could be that impact enterprises may not be creditworthy. And so we used this research report to dig into that and to test this hypothesis. We looked at balance sheets of the 400 impact enterprises that we were studying and essentially created a stylized credit rating methodology based on a set of core indicators that might suggest at least an ability to absorb and service debt. So things like revenue growth, EBIT margin, cash runways, current ratios. And we find that almost 2/3 of these enterprises demonstrate at least some baseline characteristics of creditworthiness. Now, certainly, deeper due diligence would be required on any individual company, and you'd want to go far beyond just what you find on a balance sheet to really understand the fundamentals of a business and what types of debt might be correct. But in aggregate, at least, it appears that the simple story that impact enterprises aren't creditworthy and aren't able to absorb debt doesn't seem to hold water for the set of companies that we looked at. And so it leaves us with a little bit of a mystery that hopefully our panel will dig into some today, which is, why is it that we see these enterprises that appear able to absorb and service debt, and for whom we might imagine the use of debt could be an important element in financing their growth and increasing their ability to have impact in India, yet we see relatively low uptake in the market and relatively low adoption and use of debt to that end. And so I'll pause here and turn it back to Ramraj to discuss some of the implications and hypotheses, and then we can start our panel discussion.
Ramraj, you're on mute.
Okay. Can you guys hear me now? Okay. So let me. Can you guys see it now? Okay. Can you guys see it? Right? Okay. So I think the whole idea is that we created this sort of what Sam called the stylized credit rating methodology, and we can go into the details of that. But the whole idea is to really So, as Sam was saying, we can discuss about the rating methodology and the right or wrong about it, but it does look like there's a reasonable number of companies which are, as you can see, in category A and B, which are really the dark blue and the light blue bars. And there does seem to be a space, as to, a material gap between what is it that impact enterprises can support in the form of debt and what is the existing level of debt. So what I'm going to do is really look at some of the reasons and some of the potential solutions. So maybe Sam, you can go to the next slide, please. Yeah. So I think there are a range of barriers as to why this gap exists. I think one is that they just struggle to find and secure loans. Maybe the network doesn't exist. They don't know the right kind of organizations. There's a challenge with just the ecosystem for impact enterprises to know about debt, to access debt. It could just be a capacity issue in terms of the quality of the financial controllers and finance CFOs that exist in some of these enterprises. One. Second is lots of the models that a lot of these impact enterprises are considering are quite bespoke. Whereas banks are used to large scale model-based wholesale lending, for that matter, SME approaches. And therefore, they don't necessarily fit into what is it that a bank may be looking at in terms of very easy model to appraise and lend. NBFCs, yes, there are a lot of NBFCs in this space, but lending rates are high, so that becomes a bit of a challenge, and then you really start thinking about the cost of debt vis-a-vis the cost of equity. The serious issue in terms of data, obviously organizations are just about starting off. They're trying to build their business model. I think the focus is so much on the customer and getting the basic minimum viable product and all of that stuff in place, unit economics and all of that. Possibly the focus on getting the right kind of data, right kind of systems to give control and comfort to lenders, not control so much, but comfort to lenders is an issue. And yes, I would also want to believe that government regulations, maybe we can get more support from the government in terms of availability of domestic and offshore capital. So a whole host of issues, right from exposure, access, sources of funding, banks, NBFCs, lack of data, and government regulations, a complex kind of puzzle because of which we don't see a lot of debt uptick. Maybe we move to the next slide, Sam. Okay. So there are two ways to sort of think about this. The one way to think about this is what can we do with existing instruments, and then other way to look at it is what else can be done. So the way we kind of thought about this is in two parts. Is one is to really think about, can we look at debt not only in terms of pure play senior debt, because that's the conventional language that a corporate bank or a large bank uses, which is pure play secured senior debt. But in our opinion, I think there's a need for us to think about debt as a continuum, and starting from maybe grants, pure play grants, repayable grants, junior debt, preference capital, quasi equity, and then senior debt. And I think today this continuum of investment options is not as rich as it can be. And I think there is a very, very strong need and a strong opportunity for foundations, for concessional capital, and for other sources of high risk debt funding, which is quasi equity, to come in and support the build out of the debt financing and impact. Let's move to the next slide. Also, I think what else can be done to improve access to debt? I would say one, definitely popularize the AIF model. It's becoming increasingly popular now. We are seeing more debt AIFs come in. Debt AIFs have come in definitely in the larger segments of the market. We want to see debt AIFs come in into the impact space. Second is clearly educating the ecosystem. That's something that the IIC would like to take up and ensure that as the impact sector grows, how can you really educate social enterprises, impact enterprises to think seriously about considering debt as a viable option. The third is really partnerships. How can we create partnerships between credit guarantors like Eric from USAID, people like Ajay from DFC or Yasmin from CDC? How can we create partnerships between banks, impact investors, conventional lenders, credit wrap providers, if I may say, grant financiers, foundations who want to support, I think is the third thing. And the fourth is really how can you continue to build on existing products, like some of the products that USAID has got in terms of a pure play credit guarantee? How can we really scale it and take it to a larger thing? So I think that's the quick kind of a summary, and I'm going to just sort of end now. But just to summarize, I think in our perspective, there's a gap in terms of the availability of debt. There are multiplicity of issues why this gap exists, but we do believe that there are strong opportunities which can be used by this by the sector with the help of new players to be able to support it. This is the report that we are releasing today. For all of you in the audience, if you go to the bottom left part of your screen, you will see a section called document storage or document collection. The full format of this report or the full version of this report is available here. So, I think this has been a great opportunity for IIC and Bridgespan to bring this report together. That concludes our presentation. I think we are by and large in time. So with this, let me hand it over to Vineet, if he's there, to please take this conversation forward. Sam, I'd suggest you can just stop the screen sharing so that we can go back to the regular mode. So that's about it, Vineet. Over to you. And, I'm sure we're going to have a wonderful conversation. I just want to make one last point, which I think is important, is that all of our analysis, all of our data is pre-pandemic. The pandemic has changed some of these things and we are aware of it. But unfortunately, it's very difficult to get data on all of these organizations, and, P&Ls and balance sheets are not available. So please keep that in mind when you think about what we've presented. So over to you, Vineet, and we hope we have a great discussion.
Thanks, Ramraj. Thanks, Sam, for that excellent presentation. It really is food for thought. So good day, everyone. I trust your family, your colleagues, and you are healthy and well. We have a stellar group for you today with extensive experience implementing strategies in impact debt finance for India and for many other geographies across guarantees, asset management, trade finance, and many other structures. Over the next hour, we'll be primarily covering 5 questions directed to various panelists, and post that we can take up audience questions. So let's dive right in. My first question is on the slide, is on the quite damning data that's come out in the report on how the entire debt landscape has got excessively oriented towards financial services entities rather than operating entities, and would be great to understand why that is so. For this question, I'll be requesting Abhishek and Ishpreet to respond, both of whom have had extensive experience in lending across impact debt segments. Abhishek, you're on mute.
Thanks, Vineet, and good evening, everybody. I guess Ramraj forgot to introduce me because Caspian Debt has done a lot of work, and Mount Possibility, we don't need any introductions. But for people who don't know us...
My apologies, Abhishek. I think that was just a miss. Seriously, sorry about that. I think I missed the name. Serious apologies.
You gave me the opportunity to introduce myself. So.
Okay, sorry about it.
Thanks. So I work with Caspian Debt. I lead the debt business, and out of Caspian Debt, we have provided debt to about 100 non-financial social enterprises and startups working in high impact sectors. And we do it through an NBFC structure. So everything that I say is going to be in that context. And in some sense, what I want to do is essentially break my response into 2 parts. One area being the issues in building the portfolio, and the second area being issues in financing that portfolio. As far as issues in building the portfolio is concerned, like the report also mentioned, there are a variety of operating and business models outside of the financial sector. You have all these multiple sectors. Within them, there are subsectors. Within them, there are supply chains. And within each supply chain, you may have different operating models. So there's a lot of variety and complexity. There's a lack of benchmarks for lending to loss-making entities. And the reason why that becomes important is because a lot of these social enterprises and startups are loss-making by choice. Lack of benchmarks makes it difficult to take decisions. Lastly, as far as the evaluation is concerned, the burden of proof for impact and ESG, in my opinion, is higher for non-financial enterprises. And the reason that becomes very important for people like us who are impact focused is that Unlike financial services organizations or microfinance institutions and MSME financing institution, they are by design considered to be low ESG risk. Whereas for a manufacturing entity in food and agri, healthcare entity which has disposals, it's a little complex. So all these issues make it difficult to use a very standardized evaluation methodology, making it an expensive process. It can be sorted. We are doing that, but I think we're just talking about the problems here. The other issue is around the fact that the loan requirements are not straightforward. If you lend to a financial institution, 99% of the times you may just do a term loan and be happy. Whereas in case of non-financial institutions, you have to think about providing revolving facilities, order finance, invoice finance, LCs, BGs, and so on. So essentially, when you design a lending organization, you have to design a multi-product organization. Otherwise, it doesn't serve all the purpose. In fact, if you look at the 100 companies that we financed, if we would have tried to do venture debt to all of them, it wouldn't have helped us because we wouldn't have been able to capture the upsides because the equity valuations don't permit in a lot of cases as far as social enterprises is concerned. The other issue is the lack of data being organized at the side of the enterprises. They are not savvy in terms of, if you compare it with the financial services institutions. Financial services people know what kind of data is required, so they'll provide it to you on a platter. This is not the case in case of non-financial institutions. The other issue is the lack of ability to absorb debt because it's not raw material. At the same time, as a proportion of the balance sheet, each loan is fairly large. So we do loans which have average sizes of which are 100 times the size of a NBFC retail portfolio, which makes it difficult to construct portfolio from a risk perspective. On the financing the portfolio side, as far as issues is concerned, if you look at the domestic sources of financing the portfolio, the two things are important: rating and priority sector. We are not priority sector. That goes out of the window. So no banks are interested in funding because you're not priority sector. As far as rating is concerned, getting a good rating is a tough ask when you have 70% of your loans being made to non-financial institutions. Rating agencies find it very difficult to digest that. On the international side, DFIs understand this and are ready to fund it, but they want to provide very large ticket sizes, which is very difficult to deploy quickly. At the same time, the hedging cost actually adds to the landed cost that we finally get the funding at. For smaller impact funds, they can fund smaller amounts, but there the hedging cost again adds to the cost so much that it becomes unviable when we want to lend to this segment because the ultimate lending cost has to be low. So I think those are the broad areas, Vineet, that I see. Over to you or Ishpreet, if you want to take it forward from here.
Thanks, Abhishek. Ishpreet, you've had a stellar first close on your venture debt fund. How has been your experience in this space?
Thanks so much, Vineet. Thanks, Ramraj. Thanks all. Good evening. So actually, I have a kind of a slight conflicting view here. The reason why I actually, as Ramraj mentioned, I worked with banks earlier, and I think there's certain preconceived notions which all the large financial institutes, and there are limitations by the financial institutes to fund this sector. The broader question is why there is more financing available to financial institutions and why it's not to the operating entities. And I think that the data showed that 4% of the technology companies have debt and agriculture at 16%. So there have been naturally low penetration. So we have, as bankers, before starting the fund, I funded loss-making companies out of banks. That's something which can happen. And we have funded 8-10 companies out of that in a short period of time. And the realization was, I think it's an unawareness at both the ends. At the functioning end of how banks function and the gating criteria they have. And at the, I think one point got mentioned that the companies themselves are not very aware about, the operating companies themselves are not very aware about how to take or absorb debt. So debt naturally as a connotation is generally associated with long-term debt, but there are ways to structure debt. I think where the point which we wanted to prove when I started the fund and came out of the banking job was that we do not want it to be limited ourselves with the particular bank. So if you are actually, there are structural issues with banks, you can't create a very scalable book out of that because Abhishek mentioned 2-3 points. These are EBITDA negative companies. You have to be under the MPBF financing, which is the maximum permissible banking finance of a bank. And you can practically fund working capital and some structures out of that. But if you create a program out of impact investing and funding companies which are backed by impact investor, because it's a long-term and patient capital in the business, the ways to structure debt. And that's what we actually wanted to prove in Stride, in order to make sure that we partner with the financial institutes and not be only limited to particular banks we've been working with. And we've, in the past 10 months, we have funded 10 new companies, 3 follow-on rounds of the existing companies, and we have partnered with banks in 6 of them. So the entire philosophy of whether this can be financed or operating entities are eligible for finance, or there has to be alternate sources of finance, while all of that is good for the larger ecosystem, I'm just saying about the current availability. Even if the flexing of muscles happens from financial institutes, and there's a awareness at the borrower's end, which is the operating entities end, if they have a prudent finance team, I think where there's lacking in management, there is the founders typically are creating great businesses and operating companies, and they're not very averse to finance, right? And actually they're averse to debt. Finance do not come natural to them as a subject, and they're averse to debt. Indian psychology is averse to debt, and they think that equity money is more easily available, and there's a preconceived notion that banks would not finance them, and they're limited financial institutes. All of that blended result into a curtailment of debt available at operating entities. In fact, today we have opportunities to fund in 14, 15 companies. We are just trying to figure out which are the best companies to do, and some of them are backed by prominent impact investors as well. So if I think that the opportunities are not there for the financial institutions to fund, it is there. I think the second spectrum of this is what kind of financial institutes are available to fund. So as Abhishek mentioned, Caspia is one of the leader and has been funding for a while now. I think what we require is more institutes coming, more capital, and awareness on the debt as an asset class, because generally the penchant is towards looking at equity by some of the impact investors for long-term patient capital. And if that supply side is taken care of in terms of providing quality capital, I think it can be built over a period of time. What we have seen in the past 1 year of journey, especially within the COVID, it has peaked for us. So that's what the banking plus operational learning has been till now, Vineet.
No, I think Yashpreet, more power to you guys. Just a quick follow on. I think Abhishek did mention challenges around the liabilities side. How has been your experience at Stride? Have you guys had trouble? Has it been easy?
Yeah, so as a first-time fund manager, I don't think it's easy at all, especially in a competitive market. So we did our first close, as you mentioned, and now we're building towards the final close. I think what's worked for us is that we've looked at actually use cases of debt. We have not been very particular about giving long-term debt. It's about saving the dilutions of the founder and looking at structural debt and looking at those businesses which will be very impactful in India going forward. So not by choice, honestly speaking, when we started the fund, we never had impact as a scope of lens. What we realized, we ended up funding a lot of impact companies, just because of the kind of thesis which these companies are eyeing and the kind of sectors or the kind of tiers they are touching in India. So yes, to be specific to your question, Vineet, it's not been as smooth a ride post-COVID, but I think we've been kind of lucky with some institutions backing us. And hopefully, in the next 2-3 months, we'll be able to wind up the first fund and go towards second.
Okay, that's great. Jumping to our second question on the role of global LPs, especially the DFIs, and this is a question for CDC and DFC, Yasmin and Ajay. The DFIs have been very active in pursuing fund of fund strategies, but recently we've also seen a lot of direct debt investments as well. DFC's recent investment in Samunati, CDC has been very active in this market as well on both debt and equity. It would be great to understand how have fund of funds versus direct debt investment strategies worked for you guys? Is there a preference of one over the other? Have returns been different? Has impact measurement been easier in one versus the other? Yasmin, would be great if you could take this, followed by Ajay.
Thanks, Vineet. Hi, everyone. It's a pleasure to be here to talk about this topic. I actually feel quite strongly about debt and impact investment as a slightly overlooked instrument. So I raised my hand to join this panel because I am a little bit of an evangelist on the value of this product. I would say for CDC's instruments, we have a fund-to-fund strategy, we have a direct debt strategy, but when it came to thinking about credit and expanding our toolkit, we thought beyond that as well. So we have been using instruments such as risk-sharing facilities with financial institutions or partnering with NBFCs, non-banking financial corporations, to think about putting in structures where we can essentially use them like a fund manager, and so going beyond just the pure fund strategy into partnering with banks and banking institutions, and also thinking about securitization and pooled asset structures. So I just wanted to put that kind of overarching context in the mix. So as far as funds go in particular, I think we're a bit newer. We've just brought in an intermediated credit team in the past year, and they are scaling up their business. So we're looking forward to doing more, I think, in that space. And I know in particular the venture debt story, credit to loss-making institutions in particular, is a very India-specific opportunity that I think is quite interesting, and we'll look at that, I think, going forward. As far as you asked us to compare direct versus intermediated, I think from an impact management perspective, I think what matters most is alignment between us and the partner. So whether it is a direct company or a fund manager or a banking institution, it's just a matter of getting that alignment up front about what matters from an impact management standpoint, and then making that agreement that we're committed to doing that evaluation over time. And I think it doesn't matter what type of institution it is, it just matters that you're actually aligned as people. So I don't see a distinction in terms of the instruments there. And I think in terms of the opportunities, it's really helpful for us to have that variety of instrument available, because it means that we can use the right one for the opportunity and really match to, the demand from the end borrowers with the appropriate instrument, which I think matters a lot.
Thanks, Yasmin. Ajay, over to you. I think at OPIC and now DFC had this really innovative long-term debt product for fund managers. How has that worked out for you guys? And how are you thinking about the fund route versus direct investments?
Thank you, Vineet, for your question, and excellent to be on a panel, and especially hearing from Yasmin on CDC's insights there, all of which we echo. We also have a direct strategy, indirect strategy, whether that be guaranteeing banks or loan portfolio guarantees, our participation in private equity funds. And we do have this direct product, which I'd like to talk a little bit more about. We call it our Portfolio for Innovation and Impact, or Pi Squared. So this is a program that we put together. We saw this growing number, and it kind of echoes what we saw in the study, where there was a lot of investments in financial institutions. We took the same journey. So we saw this growing number of small and growing businesses that are post Series A that required debt. And so we said, okay, let's put together a program, and you need to be $1 million in revenue or $1 million in assets. You don't need to have achieved PAT profitability, but within 2 years of the OPIC or DFC loan, you would need to be profitable. And so at first we piloted with $5 million, and we doubled that now, so we can provide up to a $10 million investment. So looking at debt or guarantees, which are a traditional product. In the future, we'll start to look at equity, and you have to be profitable within those 2 years, and we can do up to a 10-year tenor, right? So commensurate with the needs of the operating company. We've done $170 million worth of transactions, in the past 4 years across 34 companies, a third of which are in India. So, again, we started with FIs. So rather than fund to funds, I think I'm going to call it direct versus indirect. So we started a lot with indirect and direct, and we can draw some conclusions. So first, in the indirect space, it really helps us to diversify our risk. We can deploy our capital quickly, and we can expand the portfolio rapidly, right? Second, we can support different parts of the ecosystem. For example, transactions with our colleague on the panel, Caspian Investments, who's one part, and Grameen, who's one part of the ecosystem, and then with companies like Northern Arc, and we could do larger ticket sizes outside of the Pi program. also with indirect, we can learn. We can learn and understand various sectors and about companies. And then it also allows us to deploy capital with sector specialists. So like, as you had mentioned with someone at the financial intermediary services targeting investments towards agriculture, or with Avium, who does, his expertise in the housing sector. But we do have a growing number of direct investments over the last couple of years, especially within the PI program, that help us to do targeted specific sector or region. For example, we want to expand in the lower income states in the north and the northeast. And so we found Milk Mantra, who USAID knows and has done a pilot program, and we're able to expand on the program to then provide a $10 million loan for this dairy producing company, and lend in new geographies. It also helps us where intermediaries are not present. So where those banks and NBFIs are not present, and we see a good opportunity, we can deploy our capital there. I'll end there.
Fantastic. Thanks, Ajay. And for the benefit of the audience, Ajay is actually relocating with family from Washington, D.C. to Mumbai to further DFC's work in Asia. So, Ajay, it'll be great to see you once you land.
Thank you, Vineet. I'm very much looking forward and should be there within about a week's time.
Awesome. Moving on to our next topic, which is to do with more about impact areas that impact debt finance can influence, support, including agriculture, including job creation, women empowerment, renewable energy, affordable housing. And as the report highlighted, the predominant use of proceeds has been towards financial inclusion. Part of the reason, of course, is what we already suspect, that it is easier to deal with a financial services counterparty than a real enterprise. But it would be great to hear from the panel on how easy / difficult has it been to find and execute opportunities beyond inclusive finance, and ideas and thoughts on how this can be accelerated. For the purpose of this question, I'll direct this to Eric. Eric from USAID. Eric is incidentally based out of New Delhi. Eric, over to you.
Great. Listen, hey, thank you for the question, and thank you for the invite to participate on this esteemed panel. Do let me know if I have any issues with audio. I wanted to mention that USAID, we're a big supporter of credit guarantees. About 90% of our portfolio is with commercial lenders. Within those lenders, we see that it's much more impactful to push and promote access to credit from these lenders instead of one-offs with SMEs. And so that's basically been our approach. We have we're broaching about $500 million of credit guarantees by Q4 of this year. So we're very excited to be able to use that credit guarantee. But to your question, how easy or difficult has it been in certain sectors? And we've had a whole range of experiences. I'll start off with what we look for in a qualified partner. Once we start, courting or wooing our commercial lender, we want to make sure that we have a shared vision. We want to make sure that they want to enter. There are concerns, and we understand that, but that's just part of the song and dance that we play. We want to make sure that there's a business strategy, that there is some curiosity and willingness to make that bet. We look at our insurance policy as kind of training wheels for a NBFC or an impact investor to enter into a certain sector. Those are essentially our overall characteristics. In terms of our experiences, I'm going to reflect on two, maybe three, depending on time, of what we've seen in the market. One of the more difficult sectors that we've encountered, not only in India, but also writ large around the globe. And just as I speak about the globe, our credit guarantees are less than 3% default rate, which is amazing. In other words, we need to go out and find more riskier transactions. But nonetheless, let me talk about forestry. We went to the market looking for actors, lenders, impact investors, and probably spoke to a number of the folks that are on the panel and said, hey, what is it going to take for you to get into the forestry sector? Well, surprisingly, it's going to take more than we thought. We had to coach them. let them understand what that sector looks like. And a lot of the folks said, hey, thank you for that 50% credit guarantee, not for me. And so we took it with a grain of salt. We shook hands. We continued to go out there and beat the pavement. And we've actually found a partner. We found two, in fact. One that was less willing and really couldn't cross the line, but another one that was actually more excited. We gave them technical assistance on the market. We even prepped them for a pipeline of potential investments. And you spoke about them earlier. Samunati is one of our wonderful partners. They did a stellar job, and they really took our technical assistance as USAID, as folks know around the room. USAID is a grant-giving organization, and we do have the credit guarantee, and now we look to Ajay and his colleagues at DFC to really bring in that market-bearing instrument. Nonetheless, that was a difficult transaction, and happy to say that we did finish that transaction. Utilization on that guarantee is up, and expected to get even deeper. So thrilled about that. Now, another transaction that I want to take a minute on, and I do realize that we're short on time, is gender. Folks have a hard time getting comfortable with that sector. However, we did not. In fact, one of the panelists on this screen was willing to make a bet with us. And thank you, Vineet, and to your esteemed team for walking us through this bet with gender. Nonetheless, we had a lot to talk about. We wanted to make sure that MFIs, NBFCs, SMEs are all getting their share of credit. And we found a lender. And believe it or not, lender was willing to get on board. And this is a commercial lender. And typically they're bureaucratic and they're slow and they're risk averse and this, that, and the other. And they have every excuse to not do the transaction. But in this case, they were so willing, they were very able and put forth a team, a strategy, and came to us with excitement. And so, while I'm not going to mention the name of that lender because we're just not there yet in our transaction, I do want to mention that we had a wonderful experience promoting this and getting across the table on that. I have one more transaction on renewable energy, just to mention that, we did kiss a lot of frogs. We did find the right NBFC that was willing to make that bet. Part of that was the technical assistance, which panels are worthy, how do you measure that, what's the value proposition to the SME? Lots of questions, and that's what we want to see. We want to see excitement. We want to see natural curiosity. We want to see that MBC, bet to get into that sector and be a market leader, and obviously show that value to the rest of the market. That's how we use our credit guarantees. We want to show that there is value there, and that the risk perception is generally lower than what we think. And I mentioned that our overall credit guarantee portfolio with DFC is less than 3%. So proof is in the pudding. I'm going to stop there. Thank you for the time. If there's questions, do let me know. Thank you.
Thanks, Eric. Yasmin, what has been your experience, and not just in India, but you've seen this at JP Morgan, at Omidyar, and now at CDC. So what has been your experience in sectors beyond financial inclusion?
Yeah, great question. So I thought I would talk about two instruments that we are using that are helping us reach beyond the financial sector, but they involve the financial sector to get there. So I think a lot like Eric, we believe in the power of leveraging the institutions that are there on the ground that have all the processes and the systems. It's just a matter of giving them that incentive, that kind of push to step further beyond their current comfort zone of where they're lending in a way that they can still feel rigorous and complies with all the processes and the regulations they need to operate within. So first I'll talk about trade finance, and I think this is something that is, it's an age-old instrument. You could almost call it old-fashioned and boring. And impact investment is so interested in innovation. And I'll be the first one to jump on the innovation dialogue. I think it's always exciting to be, thinking about the future and solving problems. But sometimes we forget about the power of things that are tried and tested. And trade finance and other inventory-backed or documentation-backed instruments can be really powerful. I mean, the the credit profile of an instrument like that versus a loan to a loss-making, highly scaling growth business or early stage business, all right, they're totally different conversations. And trade finance is a space, I think, where whether it's trade and export import or working capital, there's demand for that, and there is a credit risk profile that is very appealing, I think, for financial institutions. And so we have actually, since 2015, we've been able to guarantee, we've put $2.2 billion worth of guarantees in place across South Asia that has mobilized $7.7 billion of capital into the market. And that is through partnership with 80 banks. And we have supported over 500 businesses through a model like that. And it's kind of an unsung hero. You don't talk about this type of model in impact investment because it's very much, I think, a DFI instrument. But I wanted to use this forum to talk about this to broader impact investors who have the capacity to think about instruments like this. It's also, I think, a great tool for us to reach into the sectors beyond financial services. So 30% or more of that portfolio is in food and agriculture, and reaching into the SME kind of segment of farmers that are just harder to reach through traditional mechanisms. So that's the kind of short-term working capital type of trade finance model. And then you have a different model, which is more general directed lending with banks as well. And you could use that with NBFCs too. But where you basically make a loan into the bank, or you put a guarantee in place with the bank that says, please use my capital in this direction. And so we are building a program around that now. We are, we have impact priorities around climate, around gender, and you could put other boundaries around it. In Africa, for example, we are targeting some of the kind of tougher countries. You could do the same with states in India, and really direct the capital into the places where you want it to go. So I think there's just to come back, I think there's a lot of value in looking at some of those tried and tested tools that may not be on the radar of impact investment dialogue today. We spend a lot of time talking about fund structures, and I think especially for the larger scale institutional investors who are looking at this market today, this is a space where you can say, if you can find the right structure to partner with a bank, they can absorb larger ticket sizes from you as an institutional investor, and the risk profile probably matches better what you're looking for as well. So I think there is a lot of space there for the next few years to really grow some opportunity.
Fantastic, Yasmin. I think a very sobering reality check to some of us investment bankers who keep talking of innovative instruments. I think it's a great reality check. Royston, would be great to hear your experience. And I think in your early days, you did a lot of work on microfinance, but recently things have really moved out. Over to you.
Ramraj calls me a veteran. You say early days. Clearly, I'm like one of those has-beens. But it's a joy to be here. Congratulations, Ramraj and Sam, on that amazing report and bringing it out. It's really thorough. And I think one of the key things that we've seen there, and the point you made from my early days or my black hair days, were really in microfinance as Grameen and setting that up in India. And then also as chair of Sadhan simultaneously, where we grew to finally serving 52 million women clients across the network. And really, I think one of the key points is core in what Abhishek mentioned. He talked about the two things that drive debt, rating and PSL. And then he almost gave it up and said, so PSL is not happening, so let's talk about rating. And I want to bring that to center of plate, because what Yasmin is saying is, if something's worked before, let's not just throw it out. Microfinance today has grown to the 2 lakh crores or $27 billion number that MFIN has put out, or Sidbi talked about in the opening panel on day one. Primarily because, hand on heart, the equity investors did a great job, but they could have not gone beyond a certain point if debt did not come and the floodgates were not open. So the fact that priority sector lending had microfinance on the list opened the floodgates for debt. So to Yasmin's point, if something has worked, we should be picking it up, and at every forum when Ajay is in Mumbai, and Ajay, this flag is going to go down and a Mumbai Indians flag comes up when the cricket starts. So you're welcome when you're here. The blue color is for the Mumbai Indians team. Yasmin will talk about and explain those nuances later. But the fact is, how do we bring back core focus on priority sector lending? How do we tell the world that $30 trillion is needed for SDG finance? Probably 8 or 9 trillion is needed for India. That's the gap. That means you're not going to have it covered with grant funding, philanthropy, all those sort of early parts of the spectrum that Ramraj talked about. You need mainstream capital. How do you use grant funding, blended finance to catalyze market access? How do you catalyze the mainstream funders to come in? I think that's the key that we are missing in some form or shape. In an activism manner, we need to be going to the government, to the central bank and saying, if you are focused on sanitation, make sure sanitation is in the PSF. If you are focused on agri and allied activities, that is in the PSF. If you are focused on affordable education, bring that into the PSF. Because you cannot have a list of RBI, PSL, which is different from what 2% CSR list is for MCA, which is different from what SVCF is under SEBI. I mean, come on, we can't be talking different languages when the world has signed off and 193 countries have signed off on SDGs. So let's take a common architecture, let's take a common taxonomy and then put it across the board. And then you see the floodgates open. Because if you're going to get what Ajay is unlocking or what Eric is unlocking alongside, if I'm doing something financing food security and food supply chains and value chains there, and get Nestle CSR to say, I'm going to pick up the coupon there. I'm going to underwrite or I'm going to provide an interest subvention if you're able to bring farm productivity up, or ITC. Or if you look at goal 7 and you say, I'm going to do a bond, and we've done 6 bonds in the last 18 months. So while the world has taken 3 years to do 1 bond, we've taken 3 months. We're doing SDG impact micro bonds. I want to create the world's first SDG impact bond factory. And every 3 months turn out an SDG bond, and not the $100 million fancy bond people are talking about. I want to do $1 million bonds, but hundreds of them. And say every single social enterprise you want to find, we'll bring 2 or 3 together, create an impact bond, and let's move on. And this year we'll do 1 million, and next year we'll do 10 million, where we'll bring co-investors, and the third year we'll do 100 million, where we have a social stock exchange, which we're working on with the finance minister up and running. So that's the trajectory. Otherwise, we will keep churning the pot with this sort of mindset of how do we, incrementally grow, and we're not going to hit $8 trillion. So we need to be able to say what's worked in microfinance. We have a live example, a baby that has grown up and is now studying in Harvard or the best school. That's what happened to microfinance. It's out there with the best in class. How do we make affordable education out there with the best in class? Give them access to debt. Yasmin talked about it up front. She's going to sing debt songs till the cows come home. And I'm going to sing that duet along with you, Yasmin. Because unless we get debt into social enterprises, they will end up using equity for working capital. It's going to remain small because equity is always expensive. And that's not going to kick it off the park. We need to bring in debt thoughtfully, strategically, catalytically, and that, Vineet, is going to bring us home.
So true. And as you rightly said, the microfinance industry has been a trailblazer for these very reasons on how policy actually got it right, starting from 2011 post the Andhra Pradesh ordinance issues and crisis. And I think our experience even during the last 6 months has been similar. Some of you may be aware that the government opened up priority sector for SME finance NBFCs as well. And a big reason why the financial services sector is almost out of COVID risks in the last 6 months is because of this. So Royston, fantastic point there. We're going to come back to you in a minute on our next question, which is to do with, and I'm smiling, but innovative instruments for impact finance, scalability and roadblocks. There are various very, very large asset classes within impact finance globally that have not really kind of made it big in India yet. We're not sure whether the roadblocks are regulatory. Is it risk appetite? Is it tax? Tax seems to be at the center of everything nowadays. Is it issues around diligence? So sectors such as social bonds, sectors such as securitized debt instruments, sectors such as venture debt. Why are they not making it big enough? Royston, I think you're the most experienced in this space on SDG bonds. So over to you.
Most experienced, I think. Can you hear me okay?
Yep.
Okay. So most experienced because I'm the only one who's come down the corporate ladder while everybody else like you has moved up. So in Citibank, corporate bank, investment bank, mid-market, SME, microfinance. So my journey has been sort of the race to the bottom. But really, I think the key is to say, how do we bring different pools of capital, different ways to de-risk? I think the risk-return paradigm is critical, and we should be looking beyond the traditional ways of risk return. Who else is our natural ally? I think that's the question we need to ask. Who else is interested in the same outcome that I'm interested in? And therefore, if I'm doing a goal 6 bond on water and sanitation, do I go to the mission Jal Shakti and tell the government if I can create X amount of toilets or Y amount of water, potable drinking water, then would you finance the coupon on that rate? And if I can then go and give money to a social enterprise in the water or sanitation space and say that this effectively becomes a zero cost to you if you can deliver on these outcomes, then I'm creating a completely new product. If I can go to someone in the women's empowerment space, and Eric talked about women, and go to someone or in forestry and say that if we can increase the green cover by X factor, then we will find interest subvention or an incentive for you in that realm. So how do we bring in new pools of capital? How do we bring in individuals? How do we bring in family offices? I think the key for us sitting here based on our experience over the years is saying we need who are the natural allies to come along with us. And we need to go out there and say, this is how we can de-risk you and therefore come in. Or this meets your objective. Mr. Unilever, you're interested in women's empowerment. Or Ms. Shell, you're interested in clean energy and carbon offsets. So find those natural allies, pull them together, create unique structures, and that's why the social stock exchange is so exciting. When I was invited to the Luxembourg Sustainable Finance Forum to give the keynote, it's a short story, but there were two of us. There was a deputy head of the World Bank who was listing a $5 billion bond, and I had done a $2 million. And I said, at the dinner before that, saying, you're embarrassing me. Where is $5 billion and where is a $2 million? And he said, 30 years ago, Grameen did a $27 loan, and the rest is microfinance history. So if you are able to create thousands of $1 million bonds, because you're financing affordable health, affordable education, clean energy, water, sanitation, we have created a movement. And with colleagues like Abhishek and Ishpreet and others who are of the same ilk, we're no different. We're all mission aligned. We want to make sure there's real impact. That's when we excite mainstream capital, insurance companies, private equity. It becomes an asset class. We have the template. The playbook is there of microfinance. Let's not just try and reinvent the wheel when there is one.
You're right, Rustin. I think definitely small is beautiful. I remember our smallest capital market trade on Credit Avenue that was $50,000. But so yeah, I think the beauty of doing something small is much large, much higher than I think the largest of transactions that we see. Ishpreet, over to you. How has been your experience on scaling up venture debt? Is this an asset class that can make it big? What's holding it back?
Yes, Vineet. So actually, I totally concur with Royston's view here. So venture debt, in terms of the statistics globally, especially in US and advanced countries, it's stated at 12 to 13 to 15% of the venture capital market. But in India, it's around 2 to 3%. The reason of this number being low is first about the evolution of the venture capital ecosystem, which has happened late, and second about the dearth of capital available. So another reason which is majorly stems from the fact that funds like us, when we raise money, and you can concur since you'll be also raising domestically money, basically the preconceived notion about doing this asset class is about risk return analysis, right? You are in between in terms of deciphering what kind of returns a family office is chasing. So either they'll start pegging you with a venture capital investment returns of 20-25%, or maybe some other structured finance instruments. So I think the learning which we had over a period of time, while the evolution when the venture capital market picks up, venture debt in India will pick up eventually, and the percentage itself should be a delta percentage up. But sheer intent of family offices, as Royston mentioned, to get involved and get penetrated and understand every asset is unique in its own nature and risk return is different. I think that's where we have to position it very carefully. Even if you talk about an IRRs of 16, 17% in local rupee, if that risk adjusted return is for a year or 2 years, I think that's how it has to be perceived as, rather than some other benchmarks. Unfortunately, especially asset classes like venture debt or maybe a social bonds would not have any benchmarking. How would you define benchmarking for Indian instruments right now when you have only limited market to benchmark with? You can only go back to your global peers and say, okay, venture debt is positioned at 8, 9% IRRs and interest rates in India are higher. So this is 15, 16, 17% IRRs. But if all family offices, right, start pegging you with either the debt funds like listed debt funds or bonds, that's the one benchmark, and the second benchmark is the venture capital market. You're in between. So sometimes the acceptability of the asset class itself, as Royston mentioned, whether you're going to the large corporates of the world and mentioning the CSR leg, or you're mentioning a family office to have a pool of asset class. If everybody can absorb it, that there are certain asset classes which will be in between 8 and 20, with in between 12, 13, 14%, but can give you that risk return returns, and perceptionally by that, I think there can be a big market. It's actually that education required at various levels which picks this up, as per me, what I have gone through in the past 1 year especially.
Ishpreet, for the audience's understanding, what has been your experience of credit loss in the venture debt industry?
So, globally, venture debt as an asset class is at 1.8% default globally, and that's again a statistics which actually surprises a lot of people. It went up in 2008 during subprime to 3.4, 3.5%, but it came down. Just because you work very closely with investors like some on the panel or tier one venture capital or investors who have large funds, the corporate governance of venture capital backed companies are very high. So when you start pegging it at with small medium enterprises in India and probably peg a credit default rate vis-a-vis SMEs in India, naturally it will be very low, because of the fact that the board is governed. When the founder takes any debt, it is approved. The regular board meetings, the observation and monitoring is so supreme. All of this results into a founder being very conservative in terms of debt repayment being right in terms of priority, and more or less you're as a senior secured lender, so you have rights over an equity investor as well. So I think that the preconceived notion again here is that the asset class, because EBITDA negative company, loss-making companies, that the credit default rates are high. This is not the case. And in fact, in India also, since the time it has been there, the default rates have been of the same levels.
Wow. I hope all the LPs in the audience heard 1.8% loud and clear. Yasmin, you had mentioned briefly on securitized debt instruments and your experience in that asset class. That's an area which has become quite mainstream for domestic investors, but we don't really see global investors participating in India. Is this something that CDC has considered?
Yes, and it's my background before impact investments, so I feel like my worlds are coming together. So I think structured credit has a lot of promise. It was, I was a research analyst looking at the market at JP Morgan in 2006 to 2010, so I know very well the challenges that come with that product. But I do think that at its core, it has a purpose, which is of value, which is to take a portfolio of loans and provide a diversified exposure and then different tranches through a capital structure to basically distribute that risk across different investors who have different risk return profiles. So to Royston's point, I think there is space for that structure, that product in impact investment, and it will take a few things for it to really work. And we have the appetite to do more of that, I think, as it grows. And I think in India, as you say, there's a kind of burgeoning pipeline in India. It's probably ahead of many of the other markets where we invest, and it's something that's of interest to us for several reasons. I mean, one challenge I think in making it work well is, we have looked at different types of structures that are flexible on the number of loans underlying and whether the loan is already in existence or would be issued going forward. So I think for a set of loans like in number 7 or 10, you would probably do a pooled bond issuance with a few investors and not really look to scale up the investor base. And it's very, you still need to look very carefully and due diligence each of those individual loans. So the kind of diversification benefit is there a little bit, but it's not quite to scale, if you see what I mean. And then the other end of the spectrum is a full CLO where you might have, hundreds of loans that are truly diversifying your exposure, and that you might be able to sell to, more different investors who can come in at different tranches. And that makes sense to kind of scale up your sell, if you will. So I think we're looking at the range of these things because they can serve different purposes, and because it's a kind of a young market growing into itself, there will be value in experimenting with which of these instruments is right in which types of circumstances. And then I think the role of guarantees is also very interesting here. So, especially in response to COVID, we've been looking at both fund structures and then also kind of non-fund structures, but still pooled exposures, where guarantees are serving a really important purpose, especially in first loss, but also in second loss. And so I think there's a role to play for DFIs like us to be putting in that risk, which can then mobilize commercial investors above us. So yeah, I'm interested in I don't know, Royston, whether you have a view on this, but whether it's important to be thinking, like one of the takeaways I have from this conversation is what's the value in thinking about trying to standardize loan terms across the market? Because, looking back at my experience in the credit derivatives markets, I remember there was a huge change. There was a big pivot moment when we standardized the terms of credit default swaps. Prior to that, there was so much friction, transaction cost in every deal. And as soon as there was standardized documentation, trading was facilitated. You had many more investors getting into the market. The regulations were more clear, and it really unlocked something. So just, if you don't mind, Vineet, I would like to ask Royston for his thoughts on that question.
Please. Royston?
I think the ecosystem creation is critical. So someone has to build that ecosystem around an asset class. And I think, that's the point again. In microfinance, you had equity investors, you had debt, you had policy, you had, advisors like us and coming in together. And the same thing, I think, is going to be true as we take that to the adjacent sectors or the broader impact agenda. How do we create ecosystems, nuanced products, which are tailor-made for that? And once you get into that, you begin, as you talked about, to productize them. And then you have, similar terms, you have similar taxonomy, and then you build momentum around that. So absolutely in agreement.
If I may add one point, one of the big advantages that the financial sector had was the volume of exposure per entity was big. The average exposures that I have on each entity on the non-financial side is Indian rupees 30 million, right? You want to do CLOs, you want to do securitization. By the time you figure things out, you have to talk to so many entities that you can't figure out. So whatever innovation has to happen has to try to scale down and make sure that the innovation works at a scale down level. I mean, this is I think as an industry, we are in an infancy stage. Some of the companies, for example, that Ajay has financed in the last 1 year, we have been financing them for the last 5 years, right? There's no way that a DFC can come in at that stage. It has to be people like us who will come in. But do we get the appropriate support to be able to do that? I think that's something that needs to be figured out. That's the point that I want to make.
I think great.
Sorry, I'm jumping in again, but you had people like SIDBI and you had FWWB. So landmark institutions that funded MFIs in their early days. The government should also be backing people like Abhishek, backing people like Grameen Impact, or institutional lenders in India. While what Ajay and Eric and Yasmin are doing are great, I think IIC should play a role in trying to say we need to build a broader capital markets ecosystem around these adjacent spaces if, Prime Minister, you want to meet these goals. And therefore, that momentum needs to come together.
By the way, we were the first borrowing that we got was from DFC. Ajay's colleague Anthony helped us get the funding. No Indian bank had funded us then.
Same here. Vineet, if I may come in just for a minute, this is Ramraj.
Please.
Yeah. So I think just a couple of quick points. I just thought because Royston mentioned something. I think the whole idea of this event and this session was also for two reasons. One is we see a certain critical mass, small critical mass building up in the impact space. non-financial service companies have increased in size and scale in the impact space over the last 5-6 years. Companies which were in seed stage or early stages, maybe in 2011-12. Every year we have been adding maybe about 100 to 125 companies. It's still early, as Abhishek said, but the way we saw it is in 2 to 3 years, we will see a significant acceleration in many companies. My view is in 3 years, we will have at least 100 companies to 150 companies, which will be of a certain size and scale, which will, reach at least a small critical mass, which is why we are trying to start thinking through this ecosystem now. I think that's one point. I think this other point is really something that I and Abhishek have discussed a few times, which is around the fact that impact investing really, or impact enterprise, doesn't have any regulatory definition, neither does it have any characteristic as an asset class. So one of the biggest reasons why MFI sector really grew was when, post the crisis, it got a certain, if I may say, the NBFC MFI kind of status. It kind of institutionalized itself in its character, and which is what helped it to scale. This sector still is considered as, something, which is good. Even the social stock exchange, if you see, hasn't gone down the road of trying to define an impact enterprise or a social enterprise. I'm going to stop now because I don't want to sort of come into this discussion, but these are the two key points which I thought I should make, just because this was part of the conversation that was going on right now.
So thanks, Ramraj. And I think, and I completely echo what Yasmin and Royston said. At Credit Avenue, we've tried to do roughly, $4 billion through absolutely standardized documentation on securitization, on bonds, on guarantees. But I still think we are scratching the surface, and adoption will take a long time for an ISDA or an LMA style effort to happen in India. We come to the last question, which, given the nature of the question, I will actually address to all the panelists. Given the sheer size and scale of the Indian debt market, it's huge. A state is as large as a country in Europe. Probably why we have such large COVID numbers as well. But yeah, I think impact finance very clearly, while impact finance can play an early stage role, can play a role of initiating an impact enterprise's journey. But clearly, as the baby grows, the needs are much larger, and the role moves from being a financier to a catalyzer, right? What's the best way that people on the panel believe that impact dollars, impact rupees can catalyze participation from commercial debt investors? How has been your experience? What structures have worked, not worked across guarantees, across working with asset managers, and so on? So I'm just going to go alphabetically. Ajay?
Thank you, Vineet. I'll talk about one example of our guarantee program, where we have this company, Way Cool Foods, who does food distribution and logistics. And their requirement really was for working capital. And if you talk about regulation with Reserve Bank of India's external commercial borrowing rules, India is not the easiest place to get direct capital into. There's still regulation, and it's gotten better. And one area is that still needs improvement is working capital. But what we have done in that case is provided a guarantee to InvestBank in this case, who will provide a rupee loan and in working capital. And the company is still working and growing massively year on year. However, we took that bet and we underwrote the capital, and any company involved in our guarantee is free to choose whichever bank with whom they want to develop a commercial banking relationship, right? NBFCs are there at different parts of the ecosystem, but when you're growing and you need trade capital, working capital, and even for our exporters, they need a whole nother set of tools, as Yasmin was alluding to earlier. We're there to provide that introduction and that backup support with our guarantee program. So just one example for you, Vineet.
Fantastic. Abhishek?
So as far as the companies that we have funded, what we've been able to, so we don't play an investment banking role, but we do refer companies to banks and other NBFCs. And we've seen some funding happen in the last 1 year, but it's a handful. But if you look at the way we are organized as an NBFC, What we have tried essentially is to blend money from family offices, DFIs, pure play commercial banks, commercial NBFCs, take support from the guarantees that are provided by DCA or a Rabobank Foundation. Try to build a portfolio that is a resultant of all these efforts. So all the blending has happened at our level. The commercial capital has come in, but it is been made possible because a lot of other types of funding or risk guarantees has enabled to do that, and it requires a lot of effort. It's not it. We don't know when it will materialize. So that's been my experience.
Ishpreet, over to you. Have you benefited from impact finance either on fundraise or on partnerships when you have funded?
Yes, Vineet. So actually, we've already done a structure with Michael Suzel where we funded a company backed by them. Similar structure what Ajay mentioned, much of a smaller amount, where they gave a guarantee from US and we did a structure. But we have done similar structures from banks, and I think banks can also do those structures. It's about the nimbleness. I think where it generally takes longer is about the. Hello, can you hear me? Yeah. Where it generally takes longer is about the bank's process to get it funded, and that's where probably funds like us can do it maybe in weeks' time, which typically will be months in banks. I think what excites banks and the larger commercial borrower financial institutions would be the cross-sell opportunities. So if they see right kind of cross-sell opportunities in terms of cash collections and other income levels which they can see of a potential borrower, I think that excites them to do various structures. From our perspective, where we are going towards, Vineet, is we are already lender to a lot of startups. As I said, we've made a portfolio of 10 companies in the last 10 months. And now we are going towards financing their supply chain, which is majorly financing the drivers and the farmers, something what probably a Waycool or a Stella Apps have. Right? So we are building that play for ourselves with banks. So we have already partnered with 6-7 banks, and we do co-lending structures there. I think banks have shown a lot of keenness, and especially the recent, I think there is priority sector lending norm which has got implemented. Though it doesn't, perceptionally it doesn't change much, but what it has resulted into is since a lot of corporate businesses have got struggled, a lot of banks have started looking at startups as an avenue to grow with them, especially the impactful startups. So we've seen perceptional change in the past 1 month, with commercial banks willing to participate with you in various structures. And we're already doing a couple of them as we speak.
Most encouraging. I realize I mixed up my alphabets. Eric, sorry about that.
Also mixing up my alphabet. The question was, how can we use private capital to catalyze commercial lending?
Yes.
Right. Yeah. So it's. I want to kind of echo a little bit what the Jai said. You know, obviously we're with the U.S. government. We have a guarantee, but it's not just the guarantee. It's how we're using it. So India has a very conservative market. It's the only place I've heard of a second loss. We've gone around the market and we've looked at a first loss, and we've have a couple of those to show. We're now looking at second loss. We are now also looking at blended finance, actually looking at the provision of monies either for technical assistance or the provision of monies to blend with that debt or that debt product. And so we're hopeful that proves to be catalytic. But not only is the guarantee, and not only the blended finance, but it's also the additionality of technical assistance, right? Painting that picture for bankers of that market, preparing SMEs to be bankable. All of that technical assistance. We find at AID that if you have that credit guarantee and you pair that with technical assistance, that guarantee is likely going to be a very effective program. So that's my 2 cents.
Royston, you're the grand young man of impact finance.
If I've managed to convince you that I've gone from gray hair to black hair because of my energy, then that's a victory for me. But I think what I want to call out is the opportunity. IIC came out with a report with Asha Impact that about $10.6 billion of impact investing has happened in this space. It's absolutely critical for us to see that most of that is equity, and therefore even with a simple multiplier or leverage, you're looking at a $20 to $30 billion need for debt immediately. There is a de-risking built in because these are all got Series A or B from the equity investors who are also IIC members. So how do we work with Eric, with Ajay, with Yasmin, with the Indian government and say, this is already very clearly established track record. This is definitely the need for debt. This is where we need to build a very clear ecosystem around. Let's not even try to boil the ocean. Let's just play within what we already have. Let's play in Wankhede Stadium in Mumbai, where we already have, a well-defined set of rules of the IPL. And let's get into that game and say, debt for existing impact investors. How do we bring in private capital just for that ecosystem? Can then, the guarantees be put together for companies who are impact investment sort of flagged or tagged by IIC? I encourage you to read the report that IIC and Ashraf put out and all the constant publications, because we need to be shoulder to shoulder supporting each other on this. It's not that Abhishek is competing with Grameen, who is competing with HP. We need to be able to build enough of track record to get the banks in. That's how microfinance works. Build and demonstrate track record after track record, get people to get comfortable with the asset class, and then the floodgates will open. So let's be consistent, let's be cooperative, and let's put the customer at the center.
Looks like the next pit stop for this panel is going to be RBI's headquarters. Yasmin, how has been your experience in bringing global capital into India and catalyzing commercial capital? How easy or difficult has it been for you?
How easy or difficult? So let me tell you a little bit about Catalyst going into this. I mean, I think Ramraj described it going in, but the Catalyst portfolio that we have is a portfolio seeking market shaping impact. It's all about shaping nascent markets where, because they're nascent, they don't have a lot of benchmark or precedent, and so we can take a flexible approach to our risk. This is a tool that's quite different from what some of our DFI peers have, which is capital purposefully designed for mobilizing other investors. So Catalyst actually means we are sometimes pre-mobilization, and sometimes we'll put Catalyst capital into something that isn't ready for commercial investors. And I think it's just worth calling out that there's an important role in that type of capital too. And there's kind of, on the spectrum of risk, the commercial investors will come in on the lower risky instruments, even where they still need some de-risking in place. And then there's this other side of the spectrum, which is where Catalyst likes to spend time. But having said that, I think we still have a role to play as CDC in mobilizing capital, and it's still an objective of Catalyst as well. And so what we find actually is increasingly there are guarantors who can provide the first loss or the second loss. And one of the distinctions I like about the fact that in some of the India structures we've seen, we have a second loss provider, is that it makes sure that there's skin in the game for the fund manager by taking the first loss, but then you can kind of top up the guarantee they put in by putting additional capital on top. But we see more of a gap in this subordinated tranches. And so we feel that's an important space for us to play right now. And I think we have just the right risk appetite to do that. And so we're looking at that type of opportunity. The other thing that came up earlier in the discussion, I thought I'd just reference here, is the idea, I think Royston was talking about it, the idea of a rebate based on impact objectives being delivered. And I think there's a really interesting, there's a lot of discussion about concessional finance or preferential terms. I really like the idea of using, if you're going to use preferential terms, using them linked to impact objectives having been achieved and kind of proven and demonstrated, as opposed to just going in with concessional pricing up front. Just as we're talking about blended finance, I thought I'd put that in as well. But I think there's a lot of opportunity across the capital structure, and with the right type of tool, I think we should be able to mobilize commercial capital, especially in a market like India, where there's so much opportunity.
Amen to that. I think with that, we come to the end of our discussion as a panel. We do have a couple of audience questions that have come up. I think we have got maybe 3 to 4 minutes to go through them. I think one was specifically to Ajay, which is that the DFC has pushed the envelope on catalytic debt for early stage enterprises in India. How has that worked worked for you? Has this been a sound portfolio? Do you have insights for other lenders who can follow your footsteps?
We got promoted from Washington to India. It worked well.
It was working so well, they sent me to India to do more. and you know, on that note, it's a regional remit. So I'll be looking after India, but also Nepal and Sri Lanka. So we hope to take this story forward, you know, across the region and help with Indian investments in the region as well. You know, there's a lot of commercial activity that can move forward. I think that all was going swimmingly until COVID hit. And so that is a whole nother story with regards to how the portfolio has been activating. But we are flexible with our clients and understanding. And so I still encourage a similar type of lending along, you know, different parts of the ecosystem. You know, from lending to an IndusInd down to Caspian and to Grameen, to having that mix and pushing the envelope in different, and it's a measured risk, right? So if you're doing a working capital loan and you're establishing a borrowing base and lending based on actual receivables and actual inventory, that's a measured risk, right? That we can take. It's similar to, you know, trade finance products based on exports. Those are measured risks that we can take, that we've done in small business, that I've done myself in Citibank here in the U.S., and that we could take over and for the Indian market. Thank you, Vineet, for the opportunity.
Thanks, Ajay. I think the last question of the day is, I think from the audience is for pretty much again everybody on the panel, that if there were perhaps two things, and we limit to two, otherwise we can go on and on, that you would need from the Reserve Bank of India or the Indian government to build impact debt finance, right? What would that be, right? I'll just go in reverse alphabetical order this time. Why don't we start with you, Yasmin?
I mean, one comes immediately to mind, so I might just give you one, but I think there's a cap on the fee you can charge for a guarantee if you're a foreign lender. I would look to move that.
Right. Royston, you said PSL, so something else this time.
So it has to be someone saying you can't take 3 years to do an impact bond. I can't for the life of me philosophically agree to anyone who's working with a vulnerable section but wants to do a $100 million bond and takes 3 years to do it. You have to do it in 3 months. You have to do a small micro bond and you have to get it on.
Right. Have you, Royston, just to carry that forward, have you seen offshore participation in some of the SDG impact bonds that you've done?
We've seen a lot of interest on the guarantee side for those. So like Rabo was, working with us to try and create now the world's first agri bond for Gold 2. And so to that extent, yes, we are hoping that will come in even on the outcome funding side. And the way we are designing it is that we will provide the funding upfront, define the outcomes very clearly, and say, should you meet these? And along the life of the bond, we will identify an outcome funder. Should they then come along, you will get an interest subvention or reduction, as Yasmin rightly picked up, incentivizing your impact by reducing your cost of debt.
And are you seeing any concerns from the 3-year tenor issue that FPIs have in getting offshore funding for structures like this?
So the current way we are looking at it is we are using our own balance sheet to provide the upfront funding. We will look at other family offices and others to come in. But what we do see as a great plus is that we've been able to work along with IIC and others to get the Ministry of Corporate Affairs to create and allow an escrow account for CSR to park their money to count as an outcome funder. So even if on 29th March you don't meet your outcomes, it doesn't mean that the company hasn't met its CSR target. It still counts as long as it's an escrow account, and then you get more time or 2 more years to do it. So I think creating that ecosystem is critical, and Ramraj and colleagues there have a huge task at hand if what we did in Southern 10 years ago to mainstream microfinance has to be done for the broader impact.
Wow, and such a matter of detail, it's only possible from somebody who's been in this market for such a long time.
Black hair, grey hair.
Ishpreet,
I think we need the recent move of making 100 crores less companies and less than 10-year-old company as priority sector lending was a welcome move. If we can augment this move by providing some guarantees to at least PSU banks to do some structures in a nimble manner, will further propel the credit deployment in this sector. So if central bank works closely with some of the PSU banks in terms of creating some nimble structures, I think can be a further very big ask the way it is positioned, but I think would be a very nimble way of positioning the priority sector lending further.
Ishpreet, do you also face challenges on, for example, raising money from banks for the funds you run? From what I understand, the risk weight is actually very, very high for such investments and inhibiting banks to really, and banks are the largest source of capital for the entire industry.
Yeah, so banks generally do invest in asset classes like this, and the only limitation which they feel is about blocking the equity base, and especially in today's time, post-COVID, that equity base gets blocked for any investment, direct investment into the funds. But overall, I think where it has not moved at all is again at the nationalized banks level. While private sector banks have been more nimble, I think nationalized banks have not moved. There can be allocations there because there is a limitation for them to do all of these funding themselves. But you can partner with funds like us and Caspian and others and Ordanak and yours in order to make sure they can be augmented debt providing. That's something which has been a challenge, you're right, Vineet.
Thanks, Ishpreet. Eric, over to you. What would be your 2 bits?
Yeah, sure. My next 2 cents. One would be allowing the Companies Act to play a role with impact investing. You have that AIF that allows for impact investing. How can the Companies Act help augment that? And then also press fast forward on the social stock exchange. Include some debt into that and really allow for the marketplace to blossom.
Very, 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 very pertinent points. Abhishek?
So 2 points. One is, I think if there is a way the government can encourage the Indian DFIs to play the first loss, second loss provider so that impact financiers can, get access to more commercial capital, both domestic and international. The second thing, and I know this is wishful thinking, but what kills a lot of us is that most of the impact capital is actually offshore, and bringing it onshore requires there's a huge hedging cost. If somebody can deal with a part of the hedging cost, it will make life so much easier to move the capital inside. So those 2 things.
Fantastic point. We encounter the hedge cost issue almost every single time. On the guarantees, we made a small start with NABARD. Hope to see it scale up. Ajay, you have the floor.
Thank you, Vineet. Yeah, I'll echo the thoughts on deregulating the all-in cost, and I'll add minimum average maturity as well into that. Just continuing to liberalize those areas.
Fantastic. So thanks everyone. I think we've come to the end of our session. We slightly overshot our time, but I hope this was interesting to all of you. I think over to Ramraj and the team at IIC to take forward some of these suggestions on how to mainstream debt markets. And I must compliment Sam and Ramraj for a really insightful report. I'm really looking forward to engaging with IIC, and I'm sure all of you are in furthering impact debt finance. Thank you.
Thank you very much.
Thank you all. I think that was a fantastic discussion. I think I would say very high quality conversations, and I at least have 10 questions now, but in the interest of time, I'm not asking those questions. I'm sure I can reach out to all of you. But I think this has been a very, very good conversation. We had more than 150 people, 175 plus people at some point, but we have about 150 people who've been attending this, which really shows you, the amount of interest that has been there in this. Clearly, this is a mandate that IIC is keen on. We would like to push the agenda not just on equity, but we would also like to push the agenda on debt. It is not possible for this sector to scale beyond the level unless debt comes in. And if indeed equity is going to chase new sectors, then debt also has to reach, and which is the philosophy with which we did the report. The report, as I told you, is available with all of you, but for all of you in the audience, the report is in the document section. I think this is something that IIC and Bridgespan put together, and I think most of the people here on the panel have been part of the conversation. So I think once again, thank you everyone. for being here. It's been a great conversation, and we hope to stay in touch with all of you. And last but not the least, Abhishek, my apologies. I missed out on introducing you when we started. But it's just a matter of just crossing the T's, and I think I had it up, but somewhere in
I hogged the extra limelight. Thanks for that.
Thank you all. Thank you all. Have a very good morning, evening, afternoon, wherever you are. Thanks a lot. Bye bye, guys. See you. Bye. Good evening.